Why perfect asset selection is not necessary. The case for process over precision. Many investors believe long-term success depends on picking the perfect asset at the perfect time. Research and market history suggest otherwise. Sustainable wealth is rarely built on flawless selection. It is built on structure, discipline, and time. 1. Markets reward exposure, not perfection. Broad equity markets have historically trended upward over long periods. For example, the S&P 500 has delivered long-term growth despite wars, recessions, and crises. Investors who simply maintain diversified exposure often outperform those constantly seeking the best individual stock. The key driver was staying invested, allowing compounding to work, not perfect entry timing. 2. Concentrated perfection increases fragility. Trying to identify the single best asset introduces forecast risk, overconfidence, concentration risk. Even highly sophisticated institutions struggle with consistent alpha generation. SPIVA, S&P Indices versus Active, reports regularly show that a majority of active managers underperform their benchmarks over long horizons. Perfection is statistically rare. Participation is statistically powerful. 3. Compounding favors time over precision. Compounding is exponential. Its most important input is duration, not precision. Investors who enter early enough and stay invested often outperform those waiting for ideal conditions. Small differences in entry price matter far less over 15 to 20 years than remaining invested. Avoiding catastrophic losses. Reinvesting returns. 4. Diversification reduces the need for perfection. Modern portfolio theory, developed by Harry Markowitz, demonstrates that diversification can improve risk-adjusted returns. A diversified portfolio reduces single asset dependency, smooths volatility, increases structural resilience. This framework assumes you cannot consistently identify the single optimal asset, and you don't need to. Structure compensates for imperfect selection. 5. Behavioral bias distorts perfect pick thinking. Investors often overestimate their selection ability due to hindsight bias, overconfidence bias, recency bias. Research by Daniel Kahneman shows that humans systematically overrate forecasting skill. The desire for perfection often reflects ego, not probability. 6. Opportunity cost of waiting. Waiting for the perfect asset often results in excess cash drag, miscompounding, paralysis by analysis. Time out of the market frequently costs more than minor mispricing. Long-term return dispersion is often driven by missing just a few strong market days. 7. Risk management matters more than selection. Avoiding large drawdowns has a greater long-term impact than marginally better asset picking. A good enough, diversified strategy with controlled risk, low costs, long holding periods often outperforms a highly optimized but unstable selection strategy. The structural truth. Perfect selection assumes predictable markets, accurate forecasting, consistent timing skill. Markets are adaptive and uncertain. Process outperforms prediction. Final insight. You do not need the perfect asset. You need sensible exposure, risk control, patience, consistency. Wealth is usually built not by flawless picks, but by durable systems that allow average decisions to compound over long periods.